Hey folks, welcome back to the channel. Today, we're diving into a fiery debate straight from the Senate floor. Senator John Kennedy just dropped some hard-hitting facts about interest rate hikes, inflation, and what it all means for your wallet. If you've been feeling the squeeze on your credit cards, auto loans, or just everyday expenses, trust me, you're not alone. So, let's break this down and see what's really going on. And hey, before we get started, make sure to hit that subscribe button so you never miss an update on the latest financial news that actually impacts you. All right, let's get into it.
This is not a news flash, Madam President. Americans are struggling to pay their bills. The reason, of course, is inflation. The inflation that the American people, and let me strike that. I don't want to call it inflation. Let me call it what it is, the high prices. Those high prices they were made in Washington, and they are a cancer on the American dream. And as a result of the high prices, people are struggling to pay their bills. I was looking at a report this week, Madam President, and I know you feel this in your state. People are having to borrow money to pay their bills. And they're having to borrow money on their credit cards. And I don't need to tell you that the interest on credit cards has gone up dramatically as a result of inflation. And the interest on the credit card is not like going to your bank where credit is tight. Because of inflation, interest rates on those credit cards has gone through the roof. Credit card interest rate in March was 21.51%. Back in 2019, it was 15%. Delinquent payments on credit cards are also through the roof. 9.1%, the highest in a decade. Credit card balances are higher too. Auto loans, the average interest rate on a 60-month new car loan was 8.2% last May. That's up from 5.3% in 2019. And delinquency rates on auto loans are the highest they've been in 10 years. If you look at consumer debt, it's now, last year it hit $17 trillion. Not million, not billion, $17 trillion.
High prices are crushing the American dream. Senator Kennedy didn't mince words when he said that inflation is not just some economic term, it's a reality hitting every single household. People aren't just struggling, they're being forced to borrow money just to keep the lights on. And where are they turning? Credit cards. But here's the kicker. Credit card interest rates have gone through the roof. We're talking 21.5% in March. Back in 2019 it was 15%. That's a massive jump. And it's hitting hardworking Americans where it hurts the most. Delinquent payments on credit cards are at the highest rate in over a decade. That means more people are falling behind because they just can't keep up. And if you're thinking about getting a car loan, the average interest rate for a 60-month new car loan is 8.2%, up from 5.3% in 2019. More debt, higher payments, and less money for the things you actually need. Consumer debt in the US has now hit a jaw-dropping level. Let that sink in for a second. That's not million, not billion. Inflation-adjusted debt is at its highest level since 2009. And yes, while inflation has come down, it just means prices are rising slower. They're not going down. Your grocery bill, your rent, your gas prices, they're still climbing.
It hit that number for the last year for the first time. Inflation-adjusted debt is at its highest level since 2009. Now, I know some folks are thinking, yes, but inflation has come down. Yes, it has. And I want to thank the Federal Reserve for that, because they had to do it alone. They sure didn't get help from Congress. But what does that mean? When inflation comes down, that's called disinflation. What does that mean? When inflation comes down, that just means prices are not rising as quickly as they were. That's all a reduction in inflation means. Prices are still going up, but they're not going up as quickly as they were. That's called disinflation. But prices are not going down. If prices were to go down, that would be called deflation. That would be called deflation. And as Federal Reserve Chair Powell and Treasury Secretary Yellen have both testified in front of the Banking Committee, and I hate to say this, unless we do something, these high prices are permanent.
So what's the solution? Senator Kennedy laid it out. We need to boost the economy beyond this sluggish 2% growth rate. Right now, if we break 2%, it's like people want to throw a party. But let's be real, we need 3% or higher to actually lift people up. More jobs, higher wages, and a stronger economy. The alternative, a recession where prices drop, but at the cost of job losses. And nobody wants that. This is the kind of news that affects your daily life. So if you found this breakdown helpful, make sure to like and subscribe so you stay updated on all the latest financial news.
They are permanent. Now, there are only two ways to reduce these prices. One is to go into a recession. China is in a recession. Prices in China are going down. It's too big of a price to pay. I don't want us to go into a recession. People to lose their jobs in order to get prices down. The only other alternative is to grow out of the inflation, to lift people up, to increase wages at the low end of the wage scale, at the middle, and at the upper end of the wage scale. Help everybody. And 5,000 years of human history has taught us that you cannot increase wealth. You cannot increase individuals' income. Can't be done without increasing output. So, Madam President, we in the Senate are going to have to put our heads together and figure out how to grow this economy. Not at 1.5%, not at 2%, which has become the norm. We break 2% GDP growth now, and we want to have a toga party. We shouldn't settle for 2%. We need 3% growth to lift everybody up.
And let me know in the comments, do you think the Fed is doing enough, or is Washington making it worse? Let's talk about it. All right, folks, that's it for today. Keep an eye on those interest rates, and don't forget, we're all in this together. I'll see you in the next video. Take care.